Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer at Equity Armor Investments, to discuss Nasdaq-100 technical levels following the print from NVDA last night. We'll also take a look at what to watch from Jackson Hole. Brian, it's great to see you again. Welcome back to Trade Talks. And two big things that the market's focused on this week. Clearly, it was NVIDIA earnings, and we have Jackson Hole tomorrow. What are your thoughts on Nasdaq-100 levels to watch following that print, which just blew numbers out of the water?
Yeah, it really did blow numbers out of the water. And NVIDIA obviously was up sharply in after hours trading. But when the markets opened, things started selling off. The rest of the NASDAQ sort of followed along with it. We saw the NASDAQ slowly get to 15,500 level here on the futures contract. And that's really been a key resistance level for the NASDAQ. We saw it briefly trade above there a few weeks ago. But since then, basically, if you look over the last 4 months or so, that's really been the point where it's been a tough sled really for the NASDAQ. And certainly with interest rates ticking up over the last couple of weeks here, that's made it even more difficult to give reason behind the valuations on the NASDAQ. And so I think we saw it sell off fairly hard. We saw Bullard speak earlier. Obviously, he's not a Fed governor anymore. He's part of, Purdue University now, but saying, and he's always been hawkish, obviously, but him saying that we still need to extend interest rates higher. I think that's probably a little bit more hawkish take than what we'll hear from Powell tomorrow. So, but certainly the market didn't like what he had to say either. And that sort of led to the sell-off as we saw NVIDIA basically give back all its after-hours gains.
Yeah, I mean, you have to wonder just how much higher they can take rates at this point. I mean, businesses and consumers are certainly feeling it with rates where they are. So what are you going to be listening for when Powell delivers his speech tomorrow? I mean, your 10-year around 2007 levels at this point.
Yeah, it is. Mortgage rates at 2001 levels basically for people. So it's a tough go for consumers. And just, first off, before I, mention about the speech, is consumer discretionary stocks over the last couple of weeks, the earnings have not been great for those stocks. They've gotten hit, fairly hard after earnings, a handful of them. And that even caught me off sides to some degree. But when you look at it going forward, the consumer, if we get higher interest rates even further from here, the consumer is really going to start to feel it. I think profit margin is really going to start to shrink for some of those consumer discretionary. So when I look at what Powell has to say tomorrow, what I want to hear is that really more dovish tone that, hey, if we just kind of hold steady here with interest rates, maybe we can get inflation under control. Inflation and CPI numbers year over year now below really the Fed funds rate. So there is some argument to say that, hey, keeping the Fed funds rate above 5% should be enough over the next few months to sort of control inflation back down to that 2% level. If we hear Powell say that, the markets might like that. If we hear sort of any sort of hawkish tone, it feels like the way things were trading today, that could give way to further sell-offs in the market and make, a good 5 or 10% correction, at least in the NASDAQ.
Right. And Brian, what do you think about what's happening in the volatility markets? It doesn't feel as if the VIX has moved as much as some of the volatility that we're actually seeing in the equity space, unless it's just specific to certain sectors, but it seems to be somewhat muted.
No, I mean, when you look at indices like the Spikes that tracks the Spider ETF or the VIX that tracks the S&P 500 or VolQ that tracks the Nasdaq 100, all those indices were 100% higher back in October 2022 when the 10-year note hit 4.25%. What's interesting is it also hit 4.25% again in February and March when people kind of freaked out a little bit about the banking, and the volatility indexes were 50% higher from here. So it seems like volatility is rather muted. The fear is sort of gone out of this market. And to me, it seems like it might have gotten it wrong to some degree. If I was looking to be an investor in this market, I would look for protection. I would own volatility with any sort of equity position. I would buy puts maybe as a hedge going into September here. Or if I don't have a position, I've been waiting for a little bit of a correction, I dabble in by buying an upside call in that sense. But having some sort of protection, it seems like options are relatively cheap versus where they were 6 months, 9 months ago. And that level of protection will give some comfort to investors because we are seeing the market still kind of fly around.
Right. And Brian, you know how it is when volatility is at depressed levels. It just takes one move and it can skyrocket faster than it can come down. So it would make sense to buy some cheaper protection here versus waiting for that move to happen.
Yeah, I mean, the further the rubber band gets stretched, the more difficult it becomes for the market sort of to sustain certain levels. And then you see that snapback and you get this volatility event that occurs and sort of whether it's a carpet shakeout or a more meaningful sell-off, either way, you usually get a volatility shakeout after we've seen volatility levels muted as they are right now. And so that, that could be something that's in the cards. I would watch the Nasdaq. We talked about at the top of the show the technical levels for the Nasdaq. I would watch this 15,000 level to see if we close below there on the Nasdaq, because that's been a critical level. Sort of, we've had this trading range between 15,000 and 15,500, where it seems to nicely bounce around in there. And anything we get below there seems to lead to more volatility levels. And if we get volatility in the bond market after Powell's speech, that probably bleeds into other parts of the market. And the Nasdaq is certainly one that could be hit with that.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.